So good evening, everyone. Once again, my name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you so much for joining us tonight for this session. As hopefully you know, the topic of tonight is why every investor needs a broad market exposure portfolio. And it's hosted by StashAway with the collaboration of BlackRock. I have two incredible speakers with us tonight. One is Christian Obrist, who's the head of iShares Distribution Asia for BlackRock. And the other one is Robert Ronneberger, who's the lead strategist for model portfolios and retirement solution Asia at BlackRock. So you have two real experts coming from the largest asset manager in the world, helping us demystify the topic of what does it mean to invest with a broad market exposure portfolio. I will also speak a little bit and go into the details of the StashAway portfolios managed by BlackRock that we just launched in the last couple of weeks. And obviously we'll have a Q&A session. Feel free to post your questions in the Q&A function on Zoom throughout the presentation. At the end, we'll try to find time to address all the questions as much as we can. There's also a team of my colleagues that will try to answer some of the questions in writing wherever that's possible, while obviously for questions that are directed to me, to Christian, or to Robert, we'll try to do our best during the live audience. Okay, so I guess Christian and Robert, I will leave it to you to take it from here, and I will be your clicker. So I'm sharing the presentation, and I guess it's easier for me to click for everyone rather than switching from one sharing to another. But thank you so much for being here.
Yeah, perfect. Thank you very much, Michele. It's a real pleasure to be part of this and the broader partnership. This is very exciting for us, and we're very excited to be here tonight as well. And unfortunately, my camera is not working. So you will just have to listen to me rather than see and listen to me, but that might be a good thing. So I'll take you through a couple of slides. I'll give you a little bit of background about BlackRock next to what Michele just said. And then we'll look at the role of ETFs in broad market exposure and diversification and general managed portfolios. But so Michele, perhaps we can just move to the first slide. Now, BlackRock, I suppose, is very well known as being the largest, asset manager in the world. But I think it's important to focus on a few different things, right? And in front of you, you have a slide giving a little bit of a snapshot. You have a couple of stats there with the AUM, etc. And really, it's still a young company. We're 34 years old. And it really started this journey as being a boutique fixed income manager back in 1988. And the firm was really founded around, being a buy-side firm with really robust risk management capabilities. That was the birth of BlackRock. And since then, it's been an incredible journey, which has really, focused on expanding the capabilities around a wider range of investment products and services. And everything that we do is really evolving around the philosophy of how do we benefit clients, right? So when I say we added services, we've gone from fixed income to equity and multi-asset. We've developed our Aladdin risk and portfolio management system. We through acquisition, we introduced ETFs. We have a financial markets advisory business, and we've been building out our alternative business, and a lot of what we do also focuses on portfolio analytics. But I will really stress that I think what is most dear to us are the clients, and we really focus on this concept of long-termism and sustainability. And really thinking about the needs of people all around the world and their financial needs and goals. So that's really, if I have to, in a nutshell, talk about BlackRock, I hope that's the essence that you can take away. So Michele, we'll just move ahead a couple of slides to illustrate the growth of ETFs. And just for a bit of background, I've been in the ETF business now for 10 years. It has been a wonderful journey. It's taken me around the world. And a lot of us are used to businesses and innovations that have growth, but then, after a few years, they peter out. With ETFs, it's also been an incredible journey, roughly about 30 years, similar to the age of BlackRock. But, you've just got a smaller snapshot here of 2018 to 24. You can see how the industry has really grown from strength to strength. And we actually feel that the adoption of ETFs and the growth will continue for decades. And when I say this, I'd just like to back that up with a little bit of data, but ETFs as a percentage of overall markets is still very small, right? It's not concentrated in that respect. So if you think of global equities, we're about 5%. If you think of global fixed income, we're only about 1% of outstanding bonds in the world. So the runway for growth is really big. We have client adoption at really every client segment, whether it's a central bank or a pension fund, all the way down to retail investors. Everyone is buying ETFs. Of course, not everyone is an ETF investor, but you get my point. Every type of client, and for good reason, right? The transparency, the costs, the diversification, and diversification, obviously a very important topic for tonight. So maybe if we just move to the next slide, Michele. Here I'd like to talk a little bit about when you look at APAC wealth, and if you look at this chart, you can really see that APAC, compared to the markets in the US and EMEA, the assets are really largely unmanaged, right? So if you look at the middle bar, that's APAC, you're looking at 85% of the assets are unmanaged. In the US, it's a lot higher, at 48 managed, and in EMEA, it's 27% managed. So, a lot of this has to do with just the way financial markets have matured. It's around investing culture. And then last but not least, regulation is a very important factor into how investors can consume financial products. And, if we look again at the US, you have the whole retirement 401k plans have been a big factor in the successful transition into managed assets. In EMEA, it's a little bit more fragmented in the retirement space. You have countries like the UK or Germany, France even Italy also being very matured like that, and incentivizing citizens and investors to invest into these defined contribution plans. Now, if you look at APAC, and I talk about this a lot, but the regulation here doesn't really favor the managed assets. And I think what we will see going forward is we do generally see that investment behavior does tend to converge globally. So we do expect APAC to mimic this trend. I have seen for sure that the adoption of ETFs also with retail investors, despite the distribution in the middle not really being incentivized by regulation to promote managed funds or ETFs. That hasn't really happened, but I think it's what we're seeing now with the rise of robo-advisors such as StashAway. I think it's a real important niche in the market that's being filled, and I think it's creating awareness. And this is really important in this journey as we go from single stock investing and really taking some bets, also investing with a lot of risk. So, Michele, if we just move to the next slide, what I want to show here is you see APAC markets have higher equity market participation from retail investors in other markets. So again, if you look at the left side of this chart, you can see Hong Kong, Singapore, really high up there. That's showing the percentage of the population that own stocks. And if you move to the right, and you see a lot of European countries there, that stock ownership, it's a lot lower. So you're probably asking, well, what's going on there? And you've got high stock participation, equity market participation. But again, the key point here, it's really being done without proper asset allocation. A lot of it is taking bets in single names, both on the equity and the fixed income side. But what has driven, why is there this gap? Well, I think tax, for one, is certainly a big driver of this. When you think of capital gains, and you have markets like Hong Kong and Singapore and others that have no capital gains taxes. In other jurisdictions, that looks different. So again, the interest, people are going to invest their money in different ways. So that's a big one. Then I think when you look at APAC and you look at this high participation and the shift that needs to occur to investing money that's managed. So the move, right, to thinking about diversification, moving away from thinking that it's all about picking stocks, all about picking bonds, to thinking about the portfolio, thinking about asset allocation. And the reality is, and there's multiple studies that have been done, it's really the asset allocation that drives the alpha, so to speak, right, that drives the return. The stock picking doesn't really do much, right? But it's much more important you decide how much equity versus fixed income, and then, regional, how are you going to invest this money? And this is occurring really across the board. We see it with our institutional clients as well, that we've moved away from just trying to pick, again, single line items to a much more sort of holistic portfolio management. And I think, this is really where the rise of robo-advisors such as StashAway, they're coming in, they're playing a very important role in the development of the ecosystem. And I think they're really delivering solutions that are really not accessible in the market. So this is incredibly important. You're being given access to manage portfolios, at a great cost, built with products that have proven themselves time and time again through market cycles and severe downturns, and all of this at a great price. So, I think this is an excellent development that we're seeing in the market. And with that, I will pause and I'll hand over to my colleague, Robert, who will talk you a little bit through this further. So over to you, Robert, unless I pass back to Michele.
All right. Well, thanks again, everyone, for having us. Obviously, the benefits of multi-asset solutions is probably not coming at a better time than right now. We have seen what happened over the markets in the last 6 months. Obviously, it's been quite a roller coaster. And if you look at the chart that Chris has just shared around the allocations to equity, I think a lot of people probably got burned in that context, right? So I think it's really important now to look at very well diversified portfolios, and this is essentially what I'm going to share with you right now. So we move to the next slide. We can see that there has been a lot of research done. So on the left-hand side here, you can see a study that was done by the CFA Institute in 1995, and basically what they've done is they've looked at the portfolio return and they've broken down the determinants of the portfolio overall performance. And, Chris alluded to this just now a little bit, but, the really important point here to see is that 94% of your portfolio return actually comes from the asset class selection. It's not about market timing. It's not about security selection. A lot of people are talking about, actively managed funds usually underperforming, let's say, an index fund or an ETF, so to say. So this is essentially coming back to that point that it's really important to focus on asset class selection rather than picking individual securities or trying to time the market. So in that sense, if you think of that in an ETF context, right, you obviously have the broad asset classes, fixed income and equity, but then within these asset classes, you can basically break it down quite, rigorously and have a lot of different building blocks. And that's essentially what backs, the investment strategies that we are, bringing to the table here with StashAway. Now, this is basically academia. Financial analyst journal here telling you that asset class selection is the major contributor. Now, on the right-hand side, you have the industry, Norges Bank. Norges Bank is essentially Norway's central bank, if you want to call it that way, and they're managing the largest sovereign wealth fund. And they, again, here, just from another perspective, in 2018, looked at their sovereign wealth fund and what drove their returns in their overall portfolio. And again, here it's just underlying the fact that asset class selecting asset classes rather than picking securities is really the predominant driver of returns, and this is something that you should focus on. Now, on the next slide, we can see that a little bit more in detail. So it's a little bit small. I hope you can see it clearly. But what we're trying to show you here is that in different years, there were different asset classes that performed differently. In other words, there's not a single year where a single asset class had always outperformed the overall market. If you look at the right-hand side, you can see large cap growth. 2020 returned 38%. However, if you look at it in the past few years, large cap growth obviously suffered in market downturns, let's say, 2008, or even performed a little bit worse than, let's say, cash in 2018 in markets where we experienced market stress. Now, if we look at the purple piece here, that's a diversified portfolio. So diversified portfolio, again, for us just means that we are not only allocating to equities, but we're really building a diversified portfolio that invests in equity, in fixed income. Under the equity bucket, we want to diversify that internationally across different countries and geographies. On the fixed income side, we want to make sure that we have exposures to sovereign debt, credit, including high yield. And you can see now, if you look at that chart here, that the diversified portfolio in purple pretty much sort of performed pretty nicely, relatively stable, irrespective of the year, particularly in those years where we experienced a lot of market stress. And I think this just really underpins what we've just talked about, that, being exposed to growth stocks and only growth stocks puts you up for a lot of, downturn, particularly in markets like this year. However, if you diversify your portfolio, particularly if you're considering to invest for the long term, having this nicely diversified allocation, investing in all these different asset classes helps you to basically weather times of market stress, and then in the long run, you usually come out a little bit more on the better side, let's say, in terms of overall returns, and probably also your levels of stress if you're looking at the returns of your portfolio when markets are going down. So if we move to the next slide, we can talk a little bit about the strategies that we are providing to StashAway, and I'm working for a team that's called Model Portfolio Solutions, and our team follows a very distinctive investment philosophy. On one side, we use as building blocks ETFs, mostly ETFs. So instead of making security selection, deciding to invest in Apple or Amazon or Alibaba, what we are trying to get, we're investing in broad exposures, let's say the S&P 500 or emerging market debt or single country exposures. So this is like sort of the overarching, distinctive element of how we are managing portfolios. And if you think of what I've shared in the first slide, this is really about asset class selection, not market timing. It's not security selection. It's really bringing alpha through asset class allocation. Now, the investment philosophy is distinctive in a sense that we are actually combining what we call, sort of the best pieces of two worlds. So we have a quantitative investment process that powers our allocation decisions. So if you imagine we're allocating globally to assets all over the globe, we use big data, AI, and all of these, fancy words that you hear day to day in our day-to-day investment process. So it's really about the ability that we have through a systematic investment process to digest vast amounts of data to make investment decisions based on that. So that is one element. We call that the quantitative element of our investment decision. At the same time, though, we have a discretionary element on top of that. What that means is that we always have our investment team and the portfolio managers, with their hands on their wheel. In other words, is like not everything can be quantifiable, particularly in times of market stress. So the combination of these both elements really helps us to position the portfolio in a very thoughtful way, taking into context and into account everything that's happening in the market, but also being cognizant of the fact that not everything can be quantified. So it's really a combination of human brain power and sort of CPU computer power in that sense. Now, let's talk about a little bit about the alpha signals. And again, as the name says, right, these are sort of our insights that we get to forecast expected returns for different asset classes. So basically, what do we expect the U.S. equities to perform in excess returns over, let's say, 6 or 12 months, or even longer term? And here, our investment process is very, very different from your typical mutual fund that makes security selection. So a mutual fund, for example, you have an investment team, you have a portfolio manager that basically eventually decides, okay, I want to invest in company A, B, and C. And then you have the analysts that are visiting companies and trying to figure out, how the company is performing, trying to, calculate an intrinsic value of this company. So that is the traditional mutual fund sort of world. For model portfolios on our end, it's very different. If you look at our analyst teams, they're basically all very quantitative driven people from backgrounds in financial engineering, quantitative, mathematics. A lot of them actually have a PhD as well. So they don't visit companies. What they do is they look at the returns of broad markets, asset classes, and trying to determine what really drives that. So in other words, how can we squeeze some alpha out of these, different allocations that we have? So that's sort of in a very, very generic way about how we build our signals and how we make that asset allocation from a quantitative standpoint. On the right-hand side, then you can see that this is like a global team. So right now we are based here in Hong Kong, but we have research hubs pretty much all over the globe in London, San Francisco, New York, as well as Sydney, and here in Hong Kong. And the team is very global and set up because every team leverages the same insights that we have from a pure quantitative standpoint. Last but not least, we talk about the BlackRock advantage. Chris talked about the history of BlackRock, and he mentioned, Aladdin. Aladdin is, our portfolio management, but also our risk management system that pretty much underpins everything that BlackRock does. And for our solutions, these model portfolios and our investment strategies is basically also underpinned by these risk management systems. So in other words, like every investment decision that we make is an active decision. We understand the impact on that decision on the overall portfolio. And at the same time, we all have a lot of independent, teams within the firm that make sure that we're always aligned with our, objectives and in terms of what we're trying to deliver. Now, moving to the next slide, you can see a little bit of that in action. So this is, an example here for a 60-40 portfolio. That means that 60% is allocated to equity and 40% is allocated to the fixed income. And we talked about using ETFs as building blocks, right? ETFs are passive building blocks. That means they're following an index. What we are doing here is we're taking these passive building blocks and use them in an actively managed investment strategy, essentially the model portfolios that we're working with on StashAway. Now you can see over a time frame of approximately 6 years that how the allocations are changing as we are changing our, as we are rebalancing the portfolios. So obviously we are very close to the market, and based on the market environment, we make very active decisions in terms of where do we want to allocate at what point of time. So if you look here in the middle of that chart around, September in 2016, it says here we sold emerging market stocks and bought U.S. stocks after the Trump election. It's a funny comment to make, but essentially what the research has shown in the past is that at the election of a Republican president, usually we have a relatively strong performance in U.S. stocks. At the same time, of course, this is sort of broad wisdom that, market brings to the table. But, what we've seen also when we made that allocation is that our sentiment signals basically turned very positive for United States equity. And so combining, again, the idea of quantitative signals, we talked about the alpha signals with our discretionary overlay from the portfolio managers, we basically make these decisions on the go, and again position these portfolios appropriately in the context of the market environment. So moving to the next slide, we can have a quick view in terms of our views. So this is from July 2020. things have changed ever since, obviously, a little bit more. But, broadly speaking, on the right-hand side, you can see developed markets, we're underweight. Why are we underweight? Well, I think it's relatively clear in terms of where we stand in the market environment. If you're close to the markets this week, for example, actually, we're expecting 500 basis points of rate hikes across in multiple countries in their monetary policy meetings. So again, hiking interest rates, tend to be negative for equities and growth assets in general. So at the same time, we're now having positioned our portfolio on a relatively, let's call it a cautious perspective. Now, coming back to the 60-40 portfolio, that means that we probably don't allocate 60% to equity, but rather less, and then fund these positions from some of the asset classes where we see more upside, for example, global credit. So I think that gives you a very high-level overview in terms of how we manage the portfolio, but more importantly, that this is really important to have a diversified portfolio. And diversification not only means to have allocations to equity and fixed income in your own country or in a particular region, but really to think about it from a very global perspective. You want to be globally diversified across these, different asset classes. And of course, at the same time, make sure that your allocations are very much aligned with where the market is and where the market is going. And I hope, I brought that a little bit to life with the slides that I've just shared. So, Michele, I will send it over to you.
Yeah, thank you very much, Robert. So you definitely did bring to life a lot of the work that goes, I guess, behind the scene and leveraging all the BlackRock assets in building global exposure for your clients. And before I go a little bit deeper into what we call the general investing portfolios powered by BlackRock, which are now available on StashAway. What I heard from Christian is very, very coherent to what we have been saying in StashAway, and I've been saying personally in many seminars around the need for global diversification, about why we picked ETFs as the way to get exposure to the various asset classes, and the fact that in Asia, there is, or in the countries where you operate, today there is people from Singapore and Malaysia in particular connected to the call. In both Singapore and Malaysia, people have a lot of savings but don't invest enough. There's one data. The second data is when they invest, people tend to invest without a proper asset allocation, but rather selecting stocks. I think the data that Christian shows kind of confirm some of our narrative in the past. And as long clients of ours have probably heard me talking about before, we've always said, forget security selection, focus on asset allocation. And you can find actually some of our StashAway Academy videos on the app talking about exactly this topic and why we kind of agree with what BlackRock has been saying over the last few minutes. Now, Robert gave us a lot of background on how kind of his team thinks about asset allocation. And I'm very proud that StashAway is the platform where you can get access to everything that Robert just mentioned in the usual simplicity and with the usual low fees and very easy to use platform. So I'm actually extremely proud of the fact that BlackRock picked StashAway to bring this to market in our region. So let me maybe go in a bit more details on what you can find on the StashAway platform right now, linked to the general investing portfolios powered by BlackRock. And then maybe we can open for Q&A. I saw already quite a few questions coming up. Feel free to kind of use the Q&A function on Zoom to add some of your questions. So first of all, if you open the StashAway app and you decide to open a BlackRock portfolio, you will have 4 choices, from conservative to very aggressive, depending on the risk that the portfolio is taking, and in particular, depending on the target benchmark that the portfolio is taking. So conservative mirrors a 20% fixed income, 80% equity portfolio. Balance is 60-40, aggressive is 80-20, and very aggressive is 100% equity. Each portfolio has between 15 and 25 ETFs. And as Robert showed in the in that example where I think we're showing the balance 60-40, and we're showing the kind of the changes in asset allocation over time, reoptimizations are actually quite frequent, 4 to 6 times a year. Robert kind of gave you a little bit of an example there, so you can expect the same to happen. The goal is to seek optimal risk-adjusted returns over the long term. So this is coherent with our philosophy. This is long-term investing. In the chart, you can see that portfolios have obviously equities exposure, fixed income exposure, as well as non-traditional exposure. So they might not mirror exactly the benchmark. So having a balanced portfolio that is benchmarked with a 60-40 portfolio does not mean that the components are going to be exactly 60% equity, 40% fixed income. As you can see from the chart, actually, there might be non-traditional assets like real estate or commodities, and the percentages therefore might differ. But let me make a step back and maybe go a bit deeper into kind of the 4 steps of portfolio construction. And Robert, apologies, I may be simplifying it a little bit for the sake of kind of explaining it quickly. Obviously, what's behind is very sophisticated and a bit more complex. I will try to simplify it a bit and demystify the logic a little bit. Now, there are 4 steps. The first one is identifying cost-effective and efficient ways of getting exposure to certain asset classes, so the holdings. Second is defining allocations. The third one is evaluate risk and opportunities that are specific to a certain point in time. And lastly, it's about monitoring and adapting to market conditions over time. Let me start from the first point. So the first point is about identifying asset classes you want to have potentially exposure to, so to include in your universe, and identifying the best way to get exposure to those asset classes. And obviously, this BlackRock portfolio we just launched use ETFs to get exposure to this asset class. I may have mentioned earlier it's actually UCITS ETFs, and the selection is very broad. There is more than 300 iShares ETFs that the strategists pick from across different asset classes, so equities, fixed income, commodities, real estate, across regions, of course, global ETFs as well as more regional ones from, emerging markets or United States or, specific countries or specific regions, as well as by strategy. They can be by industry. So it can be a specific industry on the equity side, or can be by structure on the fixed income side, or by, volatility. And there is also some smart beta and kind of income focused ETFs that can be looked at. So this is the first step, identifying the universe. The second step is, given the universe, identifying what is the kind of target asset allocation. So what you see here in this example is on the left side, you see the investment universe. This is obviously not exhaustive. It's not the whole 300, and it doesn't cover all asset classes. But, you have on the fixed income side, you have a US government bond, 1 to 3 years, 3 to 7 years, 7 to 10 years, over 20 years. And those will actually behave differently in different parts of the cycle, as the yield curve might change shape over time, and therefore the returns of each of these different maturity fixed income products will have different returns over time. Or on the equity side, you can have the S&P 500 or the MSCI Equity World or MSCI Equities Asia Pacific minus Japan, et cetera, et cetera. So you can actually see there is quite a few choices. Of course, again, this is not the full list. As I mentioned, there is more than 300. So once you have this universe, Robert's team does what actually Robert explained better than I can earlier, of looking at the characteristics of expected returns, risk, and cost of each of these components, and how these components behave together. So, kind of the correlation logic behind this, in order to provide for the optimal asset allocation. So what you see on the right side is kind of the first step of that asset allocation. So let's say you are targeting this is probably a 60-40 portfolio. You will have a 40% income, fixed income, and then you can see the detailed allocation to different parts of the yield curve, of the maturities, as well as some corporate bonds and some investment grade bonds. For instance, you see 5.6% US investment grade bonds at the bottom. On the equity side, you see as well overall allocation, in this case 52%, with an allocation by geography. So S&P 500, large cap US, 14.5%. minimum volatility strategy, another 10%, or you have Japan, 3.8%, emerging markets, 5%. These are the specific allocation that Robert was talking about earlier when he was showing you the tilts that get made, 4 to 6 times per year. Now, there is a third step, which is actually looking at shorter term tilts. And this is looking at discretionary views. Again, Robert made a few examples earlier. So for instance, that portfolio we looked at earlier, the 40% fixed income and 52.1% equities with a 3.8% allocation to Japan and a 5% allocation to emerging markets, might be tilted to a slightly lower fixed income allocation, a slightly higher equity allocation in a macro situation where equities are an overweight for Robert's for BlackRock's team, and therefore, and then more specifically, you might see actually even within the broad asset class or within equities, you might see an over allocation to S&P 500 and under allocation to emerging markets. You see here the S&P goes from 14.5% to 18.5% in this example, and emerging markets go from 5% to 3.6%. This is probably because this is obviously an example, it's not what's happening today, but it would be probably happening in a situation where you have positive general equity markets, positive macro environment for equities, but at the same time, a strength in the US. So for instance, Robert was mentioning earlier, when a Republican president gets elected, equities tend to do well. And so you might see an underweighting on the emerging market and overweighting on the US. That might be the case in the picture we're looking at right now. So this is where you actually have the more frequent tilts to the asset allocation. Again, the logic is remaining obviously within the risk targeting that you've chosen. If you've chosen a balanced portfolio, remain a balanced portfolio, but trying to maximize returns over time. The fourth and last step is about monitoring and continuously improving this. And what you see here is annualized returns since inception of the 4 portfolios that are now available on StashAway up to the 31st of July 2022. So you can see from 3.5% per annum for the conservative portfolio to 10% per annum for the very aggressive portfolio. You can see the dates in which this portfolio were launched. So for conservative, balanced, and aggressive, this was at the end of 2014, while for very aggressive was in October 2016. So it's a slightly shorter timeline. But you can see here, obviously a different risk level, how the various portfolios have behaved. So these are kind of the 4 steps, starting from selecting a universe, building the portfolios, tilting those portfolios given, specific market and macro situations, and then obviously monitoring results and further adjusting asset allocation over time. Now, you might ask, okay, how does this fit within the overall StashAway offering? StashAway has now been live for 5 years. We have actually quite a few products, and these portfolios by BlackRock are kind of the last additions to our offering. So let me maybe spend 3 minutes explaining how this all fits together, and then we can open up for questions. I can see quite a few of them in the Q&A function on Zoom. If you do have a question, please feel free to put it there, and I'll do my best to either answer myself or send a question to Robert and Christian for their answer. So 3 minutes on how does this fit into the overall StashAway offering. So as you grow your wealth further and you diversify further, your needs might change. So the basic core need that everybody has is manage your cash, having a emergency fund, making sure you have enough cash that something happens, you can get access to that. We serve this purpose with what we call StashAway Simple, which is a cash management product. In Singapore, StashAway Simple currently yields 2.1%. In Malaysia, in ringgit, yields 2.9%. And we've just launched in Singapore Simple Plus, which takes a little bit more maturity risk and has a higher yield. Right now, it's between 3.6% and 4.1% per annum. So this is your kind of cash management. Obviously, Simple being the cash you might need any day, and therefore you might want to make sure that you never have a negative day. StashAway Simple Plus is when you know that you don't need the cash for a few months at least, and therefore you can take a little bit more maturity risk. You might see a little bit more volatility in exchange for higher returns. Then we have our kind of core offering, what we call general investing, where we have the ERAA, economic regime-based asset allocation. This is kind of what we launched with 4 years ago, as well as the BlackRock portfolios. Under ERAA, you have both core as well as ESG. BlackRock, we just talked about it. And we also recently launched flexible portfolios. These are portfolios you can actually design and customize yourself, either by starting from one of our portfolios or starting from scratch, having access to a very, very long list of ETFs and being able to build your portfolio with the assistance of our tools that will tell you how much risk you're taking at any point in time. Yeah. As your wealth grows further and you want to diversify further, obviously you might want to have access to income products. So we have a StashAway income, which is only available in Singapore as of today, which is an income-focused portfolio. And then as you potentially want to diversify further, we have launched earlier this year thematics portfolios, enabling exposure to 4 specific things: technology enablers, consumer tech, healthcare innovation, environmental, and clean tech. And lastly, if you are an accredited investor in Singapore, you can also get access today to private equity, angel investing, and crypto. This is today only available to accredited investors in Singapore. So hopefully this helps you understand where the BlackRock portfolios fit together. So this is part of our core offering on how to build your broad, diversified portfolio, as both Robert and Christian has mentioned before. It kind of complements our current offering. So now you have, for our general investing, kind of have 3 options. One is your ERAA managed portfolio. The second one is BlackRock managed, and third, you want to build your own, and that's kind of the third option you have. So maybe I will stop here and open up the Q&A. And Robert and Christian, I'll do my best to answer some of the questions and send to you some of the other questions. For everyone's benefit, Robert and Christian will not be able to answer all questions for compliance reasons. So whenever they can't answer, I'll try to answer myself. Okay. So let me just go through the list. So maybe this is actually a good question for you, Robert, I think. Why broad market exposure makes sense in a recession time when everything is going down? Isn't it better to average up when markets start exiting from recession?
Yeah, that's a very interesting question, and I think it comes back to the point that you want to be diversified. So the model portfolios are essentially, allocating to a lot of different pieces. You have the equity piece, you have the fixed income piece, and the fixed income piece, we have something, that are very close to cash proxies, right? And which means that in times right now, we would basically tilt on the fixed income side, probably like cash proxies, to position us on the defensive side. On the equity side, we would basically tilt into minimum volatility equities because there are more resistance to downturns. But to your point, how do we position it in the current market environment? And that comes to the point of market timing, right? So who is, in essence, it's like who can forecast the market timing. So if we were to know that at the beginning of this year, the market would sell off by as much as we do, we probably would have moved all into equity, right? But, our research has shown across different investment teams, particularly around long-term investing for retirement, that there is literally hardly anyone that can, with a very high conviction, forecast market trends and allocate as a result of that. So in other words, this is more about staying invested, tilting the portfolio towards the defensive side on the equity and fixed income, sleeves when it comes to uncertainty in the market that we're certainly facing right now. But over the long run, if you average out your returns over the years, a person that stays fully invested compared to a person that sort of tries to time the market, the one that stays fully invested over the long term tends to outperform a portfolio that actively tries to time the market. And it really comes back to the point of the focus of StashAway and BlackRock for long-term investing rather than trying to time the market.
Thank you, Robert. So there is actually a related question. I'm going with you first, and then I'm saving some of the questions for me as in a letter. So I'm trying to make sure we have a little bit of a story. So there is a question that I think is connected or taking a different angle to what you just said, and I'll go through it now. So I'll actually read it verbatim. So it says, why go through so much effort to construct a slice and dice mishmash equities portfolio when one can just invest into a single all-world ETF that is holding global equities in its market cap weightage? Is there evidence that there is alpha to be found in thematic sector ESG investment? Is the alpha in factor investing smart beta still expected to present itself in the future now that factor investing is getting more and more popular?
Barry, I like that question. I can tell you, we've heard that many times because you obviously have these broad exposures, right, where you basically buy a ETF that uses the market cap to allocate to global equities. Now, if that solution and that single exposure would outperform, we probably would allocate to it. But, as we talked about earlier, when it comes to asset class selection being the most important determinant of your portfolio return, you want to make sure that at very specific points of time, you actually have the flexibility and the tools to overweight and underweight specific regions. Right now, for example, we have a very constructive positioning in U.S. equity, despite the downturn, and a lower allocation to emerging market, particularly when it comes to Asian equities, right? You think about, what's happening right now on the central bank, the Fed, probably hiking for another 75 basis points. The US dollar, as a result of that, will get stronger, and that will have a negative impact on emerging market equity as a result of that. So that's why we really have these different building blocks to make sure that we're allocating to, the sub-asset classes under equity, depending on where the market is moving or where we believe the market is moving. So to answer your question, yes, we believe that we can generate alpha by actively allocating to different parts of the global equity market, whether it's from a regional perspective or, as you pointed out, from a factors perspective, right? Tech sell-off, as an example, again, we talked about the different, factor exposures that we have within our portfolio. Right now, we are actually allocating a very, decent chunk towards the min vol of the S&P 500, just because we know there's a lot of uncertainty in the market right now. The sentiment is not as positive, so we want to make sure that we reflect that in our portfolio. So again, coming back to your point, I think it's important to have the very granular building blocks to deliver alpha based on these, driving factors.
Thank you, Robert. So those are kind of the two questions that were around kind of the logic behind the product. There is now one question. Maybe I'll answer quickly first, and then Robert, feel free to add on what I'm saying. So, are ETFs really better than unit trusts? Cost of unit trusts are matching up to ETFs now. So, what is the other advantages? So, in our view, and essentially, we're not married to ETFs. We use unit, for instance, Simple Plus and Simple are actually built with unit trusts. So, we try to find the right vehicle for whatever we're trying to do at any point in time. The reason that for our core portfolios, as well as for our thematics portfolios, we actually pick ETFs are, I would say, twofold. One is cost, actually. So you mentioned that, and I actually don't think it's true that you can get to the same cost level. Obviously, if you take the most expensive ETFs, they might be as expensive as the cheapest unit trusts. But when you actually compare apples and apples, large cap US versus large cap US, or specific sectorial exposure versus specific sectorial exposure, you'll actually get very, very different numbers in terms of cost. But the second reason is that because, as Robert showed earlier, security selection gives a very, very little benefits to overall portfolio construction. So when you buy, so I'm now simplifying, usually unit trusts tend to be actively managed and ETFs tend to be passively managed. It's not 100% true, neither of the two. So there are some actively managed ETFs and there are some passive unit trusts. So I'm talking about ETFs as passive and unit trusts as active. So when you buy an active fund, de facto you are buying security selection. And as Robert showed you earlier, the investment or the cost you're paying for that security selection actually doesn't end up giving you much returns. And this has been proven in a different in a number of different ways. One way is what Robert showed you by looking at different portfolio composition. In other ways, data from SPIVA on returns over the last 20 years, and you'll see active funds actually underperforming indexes, and ETF actually match indexes. So cost is one. The second one is when you focus on asset allocation, you actually rather have instruments that move in a very predictable way, because then you can be, that's at least for our ERA portfolios, you can be very systematic because you know that a certain index, a certain set of companies will behave in a certain way when inflation increases, for instance, and that enables you to actually have algorithmic rules to manage your asset allocation more efficiently. While if the underlying instrument is actively managed, it's more difficult to know how is the human being that is actively managed that a unit trust actually will behave in a different circumstances. So it's much more difficult to use it as a building block of a proper asset allocation strategy. Robert, I don't know if you want to add something, or feel free to disagree with me if there is anything I said that you disagree with.
No, I think nothing to add, to be honest. I think it's, as you pointed out, and having been in that business for quite some time, like Christian, right? What we've seen is that ETFs are probably the most cost-effective, cost-efficient building blocks that they are. And within my few years in this industry, like even the ETF, prices and the fees have come down by they literally halved, more or less, ever since I've joined this industry. So I think from a cost perspective, it is the most efficient, way. And, just to sort of highlight that, I mean, here in Asia, we are still a little bit behind the curve. I mean, that's hopefully changing, with StashAway in terms of the, model portfolios and the way of bringing low-cost solutions. But if you look how, money is being managed in other regions, particularly in the United States, there's hardly anyone that actually invests in actively managed funds. A lot of these solutions are essentially model portfolios that use ETFs as building blocks. In terms of the business size, just as a reference for you here, in the U.S. we have close to 200 billion in these model portfolios, right? It just shows, and it's literally starting from scratch in 2010. So it really just shows that there is this big trend towards these, very affordable exposures. And again, to Michele's point, we have seen that security selection and market timing is very difficult to achieve. So having these long-term, investment horizons and using ETFs to basically position us appropriately seems to be, the way to go, in my personal opinion. And obviously, I'm a part of the model portfolios team. So.
Thank you. Yeah, I think we think very much similarly on this.
I was just going to add one point. This is Christian here. I think, as you say, or as whoever's written the question here has pointed out, that could be in some cases we have the same fees on some exposures. Overall, I would agree with Michele. We've seen extreme fee compression on core exposures, and overall, there's a lot of competition. But the other really important point is liquidity, right? Liquidity in terms of your ability to access certain markets, but also the price you pay to move risk, right? And this is the beauty here. You've got a team that can, manage that risk, but they will need to, in some cases, when they're rebalancing the portfolios, move those exposures. And that is a key benefit of the ETF. The ETF takes the unit trust structure, or let's call it an index mutual fund, and you place it on exchange. So you have, at a minimum, the same liquidity as the mutual fund, and you have the benefit of having additional liquidity through the equity market liquidity because it's trading on exchange. So therefore, you have the ability to really tap into tighter trading spreads, which you wouldn't have with the mutual fund structure. So that is a huge benefit, particularly if you're going to be turning around the portfolio quite a lot. These volatile markets would potentially, mean that could be the case. And even if not, again, you have that optionality.
Thank you, Christian. Yeah, I agree with you. So there is actually quite a few more questions. I apologize if I'm not going to be able to go through all of them, but let maybe go ahead for another 5 to 10 minutes. I'll try to solve some of the quick ones. So there is one saying, what are the benefits of buying BlackRock through StashAway instead of buying from BlackRock directly? You actually can't buy the strategy we just discussed from BlackRock directly. BlackRock does not have a retail, like a direct distribution. So you will not be able to access what you're accessing with StashAway in any BlackRock application. So that's an easy one. So there is a couple of questions on, actually, I think this has been answered. There were a couple of questions on when to choose ERAA, which are kind of a big kind of StashAway core portfolios. ERAA is our own asset allocation versus BlackRock. It looks like this has been answered by my colleagues in the back. The short, high-level answer is that the two strategies are a little bit different in the way they try to achieve the same result. So, obviously, the core BlackRock portfolio strategy is to target a broad market exposure and you can select your portfolio by a preferred stock bond ratio. So 60-40, for instance, has quite frequent reoptimization 4 to 6 times a year, and a fairly large number of ETFs in the portfolios, 15 to 25. And you can expect the ups and downs to be broadly in line with the market, so with the benchmark you've chosen. While ERAA's portfolios have as a first objective to keep your risk constant and maximize your return at that level of risk. And so, in fact, you choose your portfolio by potential downside, what we call StashAway risk index. They are a bit more concentrated in their ETF exposure. So it's between 7 to 13 ETFs in each of the portfolios. And it's reoptimized less frequently. So we've done 6 reoptimization in the last 5 years. We do not have a cadence, but on average, it's been once a year. Probably in volatile market and macro conditions, you're going to see a little bit more. So maybe in the next 12 months, it might be more frequent than this. But overall, it's been around once a year. What that means is also that, so the result of this is that while, as I mentioned, what you can expect with the BlackRock portfolios is broadly ups and downs that follow the market, with ERAA, you might expect occasional deviations from the market. So, for instance, ERAA has significantly overperformed the markets in 2018, 19, and 20, while underperforming in 2021 because of a China tech exposure, and is overperforming again in 2022. So you actually can see a little bit more deviation from a kind of a core market trends. Anyway, so this is it's all explained quite easily on the app, but these are kind of the high level differences between the two choices. And of course, as I mentioned, there is a third choice, which is flexible portfolios, where you can actually tweak the asset allocation in case you don't want some of the components in the asset allocation. Of course, there is a lot of science behind both the BlackRock managed ones as well as the StashAway managed ones. But if you have a perspective on things, obviously you're more than welcome to express it on through flexible portfolios. There is a question on overlapping. So are there any overlapping ETFs that are powered by StashAway versus the one powered by BlackRock? If there are we getting an intentional overexposure to a certain ETF asset allocation? There is no check on whether, from neither party, on whether there is the same ETF used on both sides or the same asset allocation on asset class on both sides. Every portfolio, both on the BlackRock side as well as on the StashAway side, is a diversified portfolio that is internally balanced to achieve whatever risk level and whatever objective you have. So there might be some overlap, but that doesn't create overexposure, because every portfolio will be actually exposed rightly. So if you have two portfolios that are built the right way, the sum of the two portfolio will still be built the right way. So I don't see that as a big issue. Plus, as mentioned, both strategies actually have quite a strong diversification angle. We know, 15 to 25 ETFs on one side, 7 to 13 on the other. So even if there is a few percentage points overlap, it's not. I wouldn't worry about that. There is a question from Fu asking, are you going to allow investors to choose how often to reoptimize their portfolios, or at least a manual mode where the portfolio is not reoptimized until the user clicks a button? I feel rebalancing 8 times a year is too much. So the rebalancing is 4 to 6 times in BlackRock's case. the short answer is no. You will not be able to change that allocation, because what you're really buying here is the BlackRock intelligence, is what Robert mentioned earlier, right? The access to data through Aladdin. Aladdin is a platform that is actually used by, I think, a lot of BlackRock's clients globally, and you now kind of get access to some of the insights that BlackRock has and Robert teams has. I don't know, Robert, if you want to add something about why you do this reoptimization so frequently.
Yeah, certainly. And I think it just maybe to mention, so usually we rebalance 4 times a year. What happens is that we essentially look at our forward-looking views on different asset classes and do a pro forma rebalance pretty much on a weekly basis to decide whether or not we should to rebalance, right? So when we rebalance, we really think it's really important to rebalance just in order to be positioned to where we believe we can actually earn alpha on asset class allocation. Now, what I also want to point out is that our optimization process takes trading costs into account and turnover into account. So when, for example, an alpha forecast, and I hope it doesn't go too technical, but whenever we believe that an excess return for a particular asset class doesn't really, it is not really considered like more than, let's say, the costs that are, tied to rebalance the portfolio, then we don't do a rebalance. We don't do that trade. So the overall turnover in these portfolios on an annual basis is actually relatively low because, again, the optimization process takes the trading costs and expenses into account. So I just want to point that out as well.
Thank you. One question from Chris, a different Chris. Will the portfolios include any market reverse activities, so short selling?
No, we are long only investors, and the ETFs that we're using are also all long only ETFs.
Yeah, and this is actually a topic that we discussed a little bit in one of our ETFs Academy seminars. You can actually find it on the app for free, and we actually talk about how short selling ETFs tend to be good tools for intraday protection, but actually terrible tools if you're trying to short the market over a longer period of time. So in general, don't use ETFs to short the market if you're not trying simply to do it on an intraday. And so neither the BlackRock portfolio nor the ERAA portfolio actually use any short selling ETFs. So there is a question on fees. The BlackRock portfolio and StashAway are managed by BlackRock, but it sounds like we're paying management fees to both BlackRock and StashAway. Does BlackRock have evidence that the alpha? Oh, so that's a different question. So let me first answer the first one. No, you're not paying management fees to both BlackRock and StashAway. The fees for the BlackRock portfolios on StashAway are exactly the same as the fees on ERAA portfolios on StashAway. So it's 0.8% per annum for small portfolios, going down to 0.2% for larger portfolios. This is the exact same, and actually the fees are combined. So you can have $100,000 on one portfolio and $100,000 on the other, and the fees will be charged on $200,000. So you will see actually the total amount, and therefore your fee will go down as you increase your assets with the StashAway platform overall. So no double fee here. And then we actually talked already about the alpha. We answered the question on kind of the alpha, so I'm not going to go to that. There is a question on comparing it with Schroeder multi-asset revolution. We can't talk about people that are not here, so I'm not going to address that. There is a question from Bauscheng on Robert on something you mentioned earlier. Rebalancing 4 times a year. How is the timing determined, and how the rebalancing weights are derived?
Yeah, so when we talk about rebalancing, we always talk about constantly having our hands on the steering wheel. So in other words, is our investment team, our analysts, we're constantly on a daily basis observing the markets in terms of where they're moving, right? So what triggers a rebalance is usually 2 things. One is a market in stress, a market where we believe that there are events in the market where we want to make sure that we position ourselves on a more conservative basis, right? For example, in elections, a good example is also when the U.S.-China trade war started. No one knows, no one can really assess, how this is going to play out, how long that's going to, take place. And, back then we probably wouldn't have thought that we are still in 2020 and still having these, these issues. But essentially when these events are occurring that, make it very difficult for us to assess the direction of the market, we do a rebalance and shift the portfolio towards a more conservative stance, right? The other event is essentially when markets are moving along and along, and then usually we see, okay, now if we were to rebalance the portfolio right now versus where's the portfolio, compared to that rebalance, if there's a big deviation between those two, so we call it the pro forma rebalance and the drifted weights, if that difference is too big, and we believe that we could, generate additional alpha or more alpha by rebalancing it, that's essentially when we're rebalancing that portfolio.
Thank you, Robert. There is a double question. The first one I think we answered already, so I'll ask the second one, which is any recommended holding time. I'll give actually maybe first my general answer. In general, you want to take more risk the more time you have, and less risk the least time you have. That's kind of a general rule. So if, in general, when you think about, usually the question is how much risk should I take? And the answer is depending on how much time you have and your own personal preferences and how you can actually deal with risk and deal with the fact that the more risk you take, the more ups and downs you're going to go through. Those are the two things you need to consider. So any recommended holding time is obviously longer for the more aggressive portfolio and shorter for the shorter one. I don't know, Robert, if you want to add anything or be more specific than that.
Yeah, I mean, the life cycle investing is a topic where we could spend another few hours on it. It's something that's very close to my heart, particularly in the context of retirement saving. But essentially, very similar to what you just said is, when you're early in your career, you have a very long time horizon. We talk about something that's called human capital. It's like your way from spending your human capital and transferring that into financial capital. Basically, if you have a very long time horizon and very, very young, you can basically take a very high equity exposure because you probably still have 30 to 40 years to invest, to prepare for retirement or whatever else you want to save for. At that point of time, you can take a very, relatively large equity risk. Now, obviously, then as you're moving closer to retirement or to your investment goal, when you need to have a more, security around it, then you will start to de-risk, right? You basically move from the aggressive portfolio towards a more conservative portfolio, and as you're close to retirement, you probably move into something that's a little more on the safe side. Yeah, essentially that's how we're talking about life cycle investing. That's a topic that's very interesting as well, but probably would go beyond what we're covering today.
No, I agree, Robert. I'm also quite passionate about the topic. And again, I said it a couple of times already. I'll say it for the third time. Actually, this is, for whoever is interested, if in the StashAway app, you have a tab called Academy, where you have a few videos that we recorded on some of the topics. One topic is actually about, risk across your life cycle. And it's, I think is in the investment basics one. Maybe one thing I want to add to what you mentioned, Robert, is that, of course, where you are in life matters a lot, but also your personal preferences and your personal ability to withstand ups and downs is very important, because you might be young and you have 30, 35 years ahead of you, so you can take a lot of risk. But if the moment you see minus 10% on your portfolio, you freeze and sell and stop investing, then you definitely took too much risk. So you need to be honest with yourself and build a portfolio that you're going to be able to keep investing in and keep on through the ups and downs. Let's face it, you are 35, you want to retire at age 65, you have 30 years ahead of you, you're going to have 4 or 5 bear markets and 25 corrections. So avoiding them is impossible. You need to just embrace the fact that you need to be prepared for them. And how do you prepare for that? Having the right risk level and the right diversification. That's where asset allocation comes in. But trying to avoid the downs in the market is just, if you avoid the downs, you're going to avoid the ups as well, which is then defeats the purpose. So, I guess I gave a longer answer than maybe was requested. But, this is, I guess, something I'm quite passionate about. So, again, you need to be prepared for bear markets and for ups and downs and for corrections, not trying to avoid them. It's just impossible to time it right. So we have 2 more questions, and then we're actually done. So we did a good job. So Robert and Christian, I'll ask you another couple of minutes, and then I know I stand between you and dinner, so we'll try to keep it short. So one question is, how closely does BlackRock mirror MSCI equity world? So maybe let me rephrase that. Is what are the benchmarks to the 4 portfolios, the 4 allocations, so that then maybe we can think about it as a kind of a versus the MSCI equity world?
I was just advised by our compliance personnel that I'm not allowed to answer that question.
Okay. Sorry about that. Okay, so sorry about it. So let me answer that. So MSCI equity world is a 100% equity kind of global index. And so while the actual benchmark that kind of the BlackRock 100% equity portfolio follows might be different, you could probably assume that it's not going to be, that the kind of the benchmark is going to be similar. Of course, their goal is to overperform the benchmarks, but overall having a volatility that is in line with that. If you take the other 3 portfolios, they're going to be, different from MSCI equity world because they have a fixed income component that actually will change the return over time. They are multi-assets in nature. So sorry about that, Robert. I didn't see this as a sensitive one. My fault. One more. So actually, this is the last one. How different is what StashAway and BlackRock manage portfolio from actively managed mutual funds? Are you guys not putting your own special source to portfolio management compared to just buy and hold index fund? So maybe I can start with that. I think it's very different. One thing is to be actively picking stocks, so that's security selection. The other thing is being kind of strategically managing asset allocation, so making decision on asset allocation. I think these are 2 very different activities that yield very different results. As I think the first slide that Robert presented on 94% of difference in returns come from asset allocation versus only 4% coming from security selection. So I think those are 2 completely different topics, completely different activities with completely different outcomes. Robert, not sure if you want to add something.
The only thing I want to add is, the models that we're providing are actively managed. The only difference is that we use, broad-based ETFs and market exposures instead of, security selection. So I think it is an actively managed portfolio, and the business that we have run in that context has been, relatively successful in terms of growing AUM. So I think, it sort of supports the notion that, alpha based on asset class allocation, I know we've talked about this a few times, really works.
Thank you. There was one question from Dev, but actually we answered that earlier, so I'm not going to repeat that. Sorry, Dev. I hope you captured the answer earlier. Look, Robert and Christian, thank you so much for your time. I know we went 15 minutes over what we agreed on. I really appreciate your time and the detailed answers, as well as all the presentation. For everybody that participated and are still here, thank you so much for staying on. If you have any further questions, reach out to our support at support@stashaway.com, and somebody from our team will definitely pick up your question and give you some clarifications. I hope this was informative as well. I also want to thank my colleagues from the customer experience side they actually answered, I think, more than half of the questions in writing. So thank you so much for making my job a bit easier, and hopefully everybody benefited from some of these answers as well. Thanks a lot, everyone. Have a good evening. Enjoy your dinner if you haven't had dinner yet, and we'll have a few more sessions in the coming weeks. So feel free to kind of register and come to our webinars in the future. Thank you again, Christian and Robert.
Thank you as well. Have a good one.
Thank you.
Bye-bye, everyone.